couple of quick disclosures, guys. Um, here at the Pinnacle Institute, as well as anywhere, Pinnacle is not a registered investment advisor with the SEC. Pinnacle does not provide personalized investment advice. Pinnacle doesn't provide generalized investment advice. Okay, Pinnacle will never tell you what to do, when to do it, when to get in, when to get out, how many shares to trade, how many contracts, how much profit or loss to take. Okay, all the information that you see today and or going forward is for information and educational purposes. Our goal here at Pinnacle is to help educate traders and investors who want to trade and invest on their own. And if you're going to enter trades or investments on your own, you need information to decide when and where and what and how to invest. Okay. But we do not give advice. Now, I'm from New York. I moved out here. I'm coming to you live from Napa Valley, California. But I'm from back east my whole life until 4 years ago, New York, New Jersey. So normally the only advice I will ever give you is don't wear a Yankee hat at Fenway Park. You're taking your life in your hands. Other than that, don't worry about it. All right. And guys, there is no guarantee of success. You remain solely responsible for any and all decisions you make regarding your investments. Okay. Even if you have a financial advisor that you hired to make investment decisions for you, hopefully you did your due diligence in hiring that person and asking the right questions of him or her so that, excuse me, that, they're gonna try and get the results that you want. But that is also on you. According to the U.S. government, the Federal Trade Commission, the FTC, most day traders are not profitable. Okay. Now, you know what day trading is. That's in and out, same day. Okay. Most day traders are not profitable because they have an inability to time the market or an inability to understand what makes the price of assets go up or down. And that's something that we work on here at Pinnacle to talk about how to time the market, or with a greater degree of probability to time the market to increase your probability of making a profit. And my favorite disclosure right here, really quick: all trading comes with risk. There is no such thing as a guaranteed trade. I mean, seriously, guys, if there was such a thing as a trade that was guaranteed to give you a profit, would I be here talking to you? Or would I be backing up the truck somewhere? Okay. There is no guarantee of success in the market. As a matter of fact, any trade, any investment can go against you for any reason. Look at the markets this year. We're at the end of May. We're almost halfway done with the year, and the Dow Jones is the best performing index year to date, and it's down about what, 10%? Last week, the NASDAQ was down almost 30%, 28% year to date. They've rallied this week, but all the four indexes are down. Many stocks are down from last year's highs. Some stocks like Zoom and Peloton and PayPal and Shop and Roku, these stocks are down 50, 60, 70%. Okay, from last year. So any trade, any investment could go against you for any reason. And one of the things I'm most proud of the work we do here at Pinnacle is, frankly, we teach you how to lose. If you're going to have a losing trade or investment, would you rather take a large loss or a little loss? Hopefully it's a little loss, because if you're not careful, little losses can grow up to become big losses. And matter of fact, there's an option strategy that can act as an insurance policy to protect you against loss. I'll touch on that at the end of the session this morning. Okay. And everything you're going to see is copyrighted today. You can't reproduce anything you see on social media. All right. And by all means, guys, if you have any questions, please put them in the chat box. Okay. And I'll do my best to answer them. So, what is the greatest invention of all time? Fire? Yeah, it's a pretty good one. Okay, fire's pretty good. How about the wheel? Wish I had royalties on the wheel. Wheel's a pretty good investment. Personally, my favorite, single malt scotch. Greatest investment of all time. Love to get my hands on a 50-year-old Macallan single malt sherry cask scotch. All right. Frankly, in my humble opinion, though, options are the greatest invention of all time. Greatest financial invention of all time. Now, when I say invention, I mean, if you think about it, the goal in trading and investing, figuring out what drives the markets. Well, Wall Street invented assets to trade. They created stocks years ago. Before it was just Wall Street, going back hundreds of years. But the financial powers that be in history, they invented stocks. Then they invented futures contracts. Then they invented options. Then they figured out how to trade Forex, how to trade currency. So the financial powers that be invented assets to trade, and then they invented strategies to trade them with the goal of making a profit. Okay, makes sense. All right. Why do I think options are the greatest financial invention of all time? Well, I mentioned this a moment ago. It's the one asset class where you don't have to be right directionally to make a profit. So again, if you buy a stock, a futures contract, or Forex, goes up, you make money, goes down, you lose money. You short a futures contract or a stock or a Forex lot, goes down, you make money, goes up, you lose money. So basically, if you've never traded options, every financial trade, short-term trade or longer-term investment you've ever participated in, or mutual funds, go long a mutual fund, goes up, you make money, goes down, you lose money. And you can't short mutual funds. But every financial trade or investment you've ever made has been what I call a directional trade. Get the direction right, you make money, you profit. Get the direction wrong, you lose money. Pretty simple concept. Well, again, options are the only asset class where you can get the direction wrong and still have the ability to make a profit. You can enter certain bullish options trades or bullish options strategies. The stock can go down and you can still make a profit. You could enter bearish options strategies. The stock could go up to some degree and you could still make a profit. So you can be wrong, just not really wrong. You can't be Enron wrong. I mean, if you're that wrong, if you're going out of business wrong, you deserve to lose money. But how cool is it to be wrong at all on the direction and still make a profit? I call those non-directional trades. Okay? And we're not going to get into those today, but what I'm going to share with you today is just what options are, how in actuality, while many of you have been told options are hard and complex and hard to learn, after I get done explaining them, you'll see how, as a concept, they are actually quite simple, and most of you are already familiar with the concept. You just don't know that you are, because a lot of people who teach options try and confuse you. They try and make options sound hard and I don't know, confuse you or whatever, and that's why most people shy away from them. But I'm going to explain what options are from the 5,000-foot view. But when you leave here today, you'll at least understand conceptually what an option is. Now, understanding what an option is conceptually and trading it live with real money in your account are two different things. I'm sure if any of you have trading experience, you know the difference between paper trading and real trading. Every brokerage platform has simulated trading. You can practice with paper money and practice trades. And I can't tell you how many times people say they made a lot of money paper trading and then they freaked out live. And part of the reason of that is the psychology of trading. I can guarantee you, if you make a live trade for $50 or $100, you'll pay more attention to a live $100 trade than a $5,000 paper trade. And if any of you have trading experience, you know what I'm talking about. It's like playing Monopoly. If you win Monopoly and you got a big stack of blue $500 bills, you don't walk around the neighborhood like, I'm bad. And if you go broke, and if you lose Monopoly and you go bankrupt, you don't start a GoFundMe page because it's just Monopoly. All right? Okay. So, options, greatest thing ever invented financially. Now, let's be real, guys. Why do we trade options or stocks or futures or Forex or real estate or mutual funds? Why do we trade or invest any asset? Why are we in the financial markets? One word. Excuse me, to make a profit. That's it. Now, in the pursuit of that profit, we are trying to minimize loss. I don't care if you have $5,000 to your name, a $10,000 trading account, or you're Warren Buffett managing hundreds of billions of dollars. We are all in the markets to attempt to make a profit. And while we're trying to make the profit, minimize our loss in the pursuit of that profit. Okay. Now, I say minimize loss. Markets are down 10 to 18% year to date. Many stocks are down year to date. How do you handle loss in the pursuit of profit? That goes a long way in helping you succeed as traders, but we're in the market for one reason: to make a profit. Now, let me ask you all a question, and you can put your answer in the chat box. Who's never traded options before? Anybody? Who's never traded an option before? And if you haven't, why not? I mean, if you haven't traded options, how many of you have trading experience? Okay. It's, one of the things about webinars, it's, we're not in a classroom setting. So, hopefully you'll communicate a little bit, but most people haven't traded options for the reason we talked about. And if not, why not? Okay. Well, most people think they're too hard to understand. I'm going to go so far as to say you've already traded options. You've just called them something else. Let that sink in for a second. Who knows what these are? Okay. They intimidate you. Okay, Lee, thanks for being honest. I will tell you one thing. After today, not that you're going to learn how to trade options in the next 45 minutes, but after today, they shouldn't intimidate you, or at least you'll understand why if you have experience with stock, you should add options to your quiver. Okay, so just give me a few minutes here, Lee. Okay, now remember what I said. Most of you have traded options. You've called them something else. You've been told that options are hard or complex. They're not, and I will explain. This is a flyer from my local supermarket, an Acme, or at least back when I lived back east a couple of years ago. Okay, what are all those? What are all those things on this flyer? What do we call those? We call those coupons, right? You've all seen coupons for your local supermarket. I don't care, male, female, whether you've used one or not. You've all seen coupons for your local supermarket, right? Just a simple supermarket coupon. Everybody understands a simple supermarket coupon. They are, in fact, very simple. How simple? If you have this flyer, walking around the Acme with this flyer, and you're looking to buy products, do you have to buy any of the products on this flyer? Do you have to buy any of the products in these coupons? The answer, of course, is no. You don't have to do anything. However, if you want to buy any of these products, what price do you pay? The price on the product or the price on the coupon? You pay the price on the coupon. Until when? Until the coupon expires. Ladies and gentlemen, boys and girls, you just described a call option. If you are walking through the supermarket with this flyer, what do you have? You have the right to buy any of these products at the sale price until the coupon expires, right? You don't have to buy the product, but if you want to buy the product, you don't pay the price on the product, you pay the price on the coupon, right? Right. Okay. So let's say we're walking around the supermarket with this flyer, and in this flyer, there is a coupon that says you can buy a bag of Doritos for 99 cents. Okay? Not the little vending machine size, one of those big bags of Doritos, like for a Super Bowl party or for the weekend. Okay? So you have a coupon that says you can buy Doritos for 99 cents. Okay. Now, we end up going down the supermarket to the chip aisle 7. We go to the chip aisle, and that bag of Doritos has a price tag on it of $3.99. Okay, so just to set the parameters here, we have a bag of Doritos with a $3.99 price tag on it. We have a 99-cent coupon. So we have a bag of Doritos with a $3.99 price tag on it. We have a coupon that says we can buy the Doritos for 99 cents. Okay, boys and girls, here's the first big question of the day. If I can buy a $3.99 bag of Doritos for 99 cents, what is this coupon effectively worth to you? What is the value that this coupon has? Think about this for a second. The Doritos are $3.99. I can buy them for 99 cents. How much value does the coupon have? $3. Now, in the options world, we call that intrinsic value. Why does that coupon have $3 of intrinsic value? There you go, Lee. See, you're not intimidated. You just figured out the intrinsic value of a coupon. Okay, now, why does it have $3 of intrinsic value? Because let's say I bought the coupon, let's say I have the coupon, and let's say I paid, the coupon is worth $3. Let's say I paid $3 for the coupon, which gave me the right to buy Doritos for 99 cents. I paid $3.99, which is the price on the bag. That's the value of the coupon, and the coupon expires, say, Friday night when the store closes at the end of the week. Are you with me? Okay, now, this coupon has $3 of value, but it's not money. It's not currency. It's not money, okay? So what could you do with a coupon that has value? If you don't want the Doritos, but you've got a coupon that has value, what could you do with the coupon? You have something, I mean, you can't pay a bill, a $3 invoice with the coupon because it's not currency, it's not money. But if you have something that has $3 of value and you're not going to use it, what could you do with it? You could sell it. I know you don't think of selling a lowly supermarket coupon, but couldn't you? Sure you could. Until Friday night at 11. Of course you could. Who are you going to sell it to? Somebody who wants the Doritos. Guys, how simple is this so far? You could sell the coupon to somebody who wants the Doritos. Somebody with the munchies. I went to college in the 70s. Somebody with the munchies. Somebody in Colorado, perhaps, or California, where pot's legal, okay? So you could sell the coupon to somebody else. So let's do this. Lee, I'm going to sell Lee a coupon for $1. Okay? Now, I want you to think about this. Okay? Now, I just saw this coupon has watch what we're doing here. This coupon has $3 of value and it doesn't expire till Friday night. I'm not going to use the coupon, so I sell it to Lee for $1. He just paid $1 for a 99-cent coupon. He paid $1 for the right to only pay 99 cents for the Doritos. So first of all, I sold the coupon for $1. Did I make a profit? Yes, I did. Okay. Now Lee paid $1 so that if he wants the Doritos, he can buy them for 99 cents. So if Lee uses the coupon he paid $1 for to then pay 99 cents for the Doritos, he gets the Doritos for $1.99. Effectively out of pocket, $1 for the coupon, 99 cents for the Doritos. He gets the Doritos for $1.99. What's the price on the bag? $3.99. Lee, did you just come out ahead by $2? Yes, you did. I made a profit and you came out ahead. Okay. Lee gets home, decides, you know what? I don't really want the Doritos. I changed my mind. Coupon hasn't expired yet. What am I going to do with the coupon? Lee is going to sell the coupon to Shar for $2. So did Lee buy a coupon for $1 and sell it for $2? Yes. Did he make a profit? Yes. Did Lee ever have to buy the Doritos? No. Did Lee ever have to have the $3.99 on him to even be able to buy the Doritos? No. Lee just bought a coupon giving him the right to buy the Doritos, and sold the coupon for a profit without ever buying the Doritos. Okay. Shar paid $2 for a 99-cent coupon. If Shar exercises the coupon, uses the coupon that he paid $2 for to buy the Doritos for only 99 cents, Shar gets the Doritos for $2.99. What's the price on the bag? $3.99. Does Shar come out ahead? Yes, he does. Okay. Shar gets home, decides, what the heck was I thinking? I don't want the Doritos. Coupon hasn't expired yet. Shar sells the coupon to Mary for $3. Did Shar buy a coupon for $2 and sell it for $3? Yes. Did he make a profit? Yes. Did he ever have to buy the Doritos? No. Did he ever have to have $3.99 on him? No. Ladies and gentlemen, what's going on here? Everybody's buying and selling coupons and ain't nobody bought a Dorito yet. How simple a concept is this? Just like, so Lee, you have experience with stock. You trade stock. Buy low, sell high. Lee bought a coupon for $1, sold it higher for $2. Shar bought a coupon for $2, sold it higher for $3. We're just trading an asset. Okay? Now, Mary paid $3 for a 99-cent coupon. If Mary uses the coupon that she paid $3 for to buy Doritos for 99 cents, what does Mary get the Doritos for? $3.99. Well, wait a minute. What's the price on the bag? $3.99. I understand why Lee paid $1 for a coupon worth $3, and I understand why Shar paid $2 for a coupon worth $3. Why would Mary pay $3 for a 99-cent coupon if she could just go buy the Doritos for $3.99? What might Mary be thinking? What might Mary be thinking could happen to the price of the Doritos? Maybe Mary thinks the price of Doritos is going to go up for whatever reason. Because the reality is, boys and girls, at the end of the day, myself, Lee, Shar, or Mary, if you have in your hot little hands, in your possession, a 99-cent coupon, you have the right to buy Doritos for 99 cents a bag, no matter what the price is on the bag when you get to the store. What if Mary gets to the store and that bag of Doritos is priced at $10.99? Okay, for $10.99, those better be some magic Doritos. But the reality is, if Mary has a 99-cent coupon, the Doritos are priced at $10.99. Now the coupon is worth $10. Subtract the $3 she paid, and she still made a $7 profit and didn't need to buy the Doritos, as long as it's before Friday night at 11 o'clock. Because the reality is, when you have that coupon in your hot little hands, you have the right, but you are not obligated to buy Doritos for 99 cents a bag until Friday night at 11 o'clock. Is everybody with me? Now, if we have the right to buy Doritos for 99 cents a bag, what does the supermarket have besides Doritos? They have an obligation to do what? To sell us Doritos for 99 cents a bag, come hell or high water, until Friday night at 11 o'clock. Excuse me. What if I get to the store? What if this coupon was very successful? I get to the store and they're out of Doritos, and the supermarket says, "Sorry, Steve, we're out of Doritos." What is the supermarket? I have an unexpired, before Friday night at 11 o'clock, I have an unexpired 99-cent coupon, and the supermarket is out of Doritos. What do they have to give me? If they're out of Doritos, what do they have to give me? A rain check. Why? Because they are obligated. They are obligated to sell me Doritos for 99 cents a bag until Friday night at 11. What if the supermarket says, "Hey, Stevie, sorry, dude, I'm not even giving you a rain check. There was a fire at the Doritos plant. We're not only out of Doritos. There was a fire at the Doritos plant. There is no more supply of Doritos. Big football game this weekend. NBA Finals, big football game. We're out of Doritos. It's going to cost me $7 a bag to buy Doritos wholesale. I can't afford to buy Doritos for $7 a bag and sell them to you for 99 cents. Well, guess what? Sucks to be the supermarket. They are obligated. So we have the right, but not the obligation, to buy Doritos for 99 cents a bag, no matter what the price is on the bag when we get to the store. And the supermarket is obligated to sell us Doritos for 99 cents a bag until Friday night at 11, regardless of what they have to pay for them. Right? Now, look, I'm from Jersey. If they're not going to sell me the Doritos for 99 cents a bag, I know a guy named Vinny. I'm going to get my Doritos one way or another. But legally, does this make sense, everybody? Now, let's take a look. Okay? There's your Doritos at $3.99, your 99-cent coupon. It has $3 of value. Remember, Mary paid $3 for the 99-cent coupon because what if she thought the price of Doritos was going up? Because while the coupon is a printed item and the price can't change, what can change? The price of the Doritos. So if the price of the Doritos goes to $4.99, the coupon that Mary paid $3 for, she could sell for $4. Doritos goes to $5.99. The coupon goes worth $5. Doritos goes to $6.99. So you see what I'm saying? As the price of the underlying asset, as the price of the Doritos goes up, the value of the coupon goes up. Of course, intrinsic value works both ways. If the price of the Doritos goes down, the value of the coupon goes down. And finally, what happens if for some reason, Lee, Shar, Mary, myself, what if we go to the supermarket with our 99-cent coupon and for whatever reason, the Doritos have an 89-cent price tag on the bag? What are you going to do with your 99-cent coupon if the Doritos are priced at 89 cents? Now, most people would say throw it away. Well, hang on, don't be so rash. You don't have to throw it away. But what you're certainly not going to do is not use it. Why would you use, regardless of what you paid for it, even if you got it for free, why would you use a 99-cent coupon when you could just go buy the Doritos for 89 cents? Who's going to buy an 89-cent bag of Doritos for 99 cents? In my neighborhood, we call that a Red Sox fan, but that's a different thing. So at the end of the day, guys, if you believe the price of the underlying asset, which is the Doritos, is going to go up or down, you can buy a coupon giving you the right to buy the Doritos. And remember, Lee made a profit, Shar made a profit, and Mary made a profit. I made a profit by selling the coupon to Lee for $1 that I didn't even pay for. We all made profits, and we never had to buy a Dorito, and we never even had to have the money, $3.99. Lee only needed $1 to make a profit. Didn't need $3.99. Shar only needed $2 to make a profit. Didn't need $3.99. Mary only needed $3 to make a profit. Still didn't need $3.99. Of course, until Friday night at 11 o'clock. Now, obviously, if we walk into the store on Saturday and they're out of Doritos, well, now it's too late. The coupon expired. You can't sue them. They're not obligated anymore, and we no longer have the right. Is everybody with me? Okay? So, guys, if you know what these are, I don't think, Lee, that coupons intimidate you. Supermarket coupons don't really intimidate anybody. Okay? I don't think a supermarket coupon intimidates you. But if you understand what this is, what if you saw this? Because options are just coupons. If you have a coupon that says you have the right to buy Doritos for 99 cents a bag, and you don't have to buy the Doritos, but you can buy the Doritos for 99 cents a bag no matter how high the price is when you get to the store, what if you had a coupon that said you could buy IBM stock for $135 a share no matter how high priced IBM stock went? Isn't that a coupon? Isn't that the same thing? By the way, we never had to buy the Doritos. We never have to buy IBM stock. What if I paid for this coupon, and if the price of IBM stock went up, I sold the coupon for a profit, just like Lee bought a coupon, sold the coupon for a profit, and never had to buy the Doritos? Now, There are two options. There are only two options. When people talk about trading options, there are only two options: calls and puts. That's it. A call option is like the coupon. If a Doritos coupon gives you the right to buy a stock at a certain, if a Doritos coupon gives you the right to buy Doritos for 99 cents, no matter how high price the Doritos goes, a call option gives you the right to buy a stock at a set price, no matter how high the stock goes. Put options are the opposite. Put options give you the right to sell a stock at a high price, no matter how low the stock goes. But we're going to focus on call options today. So if you understand, I'm going to give you everybody one more chance. Any questions about the Doritos coupon? That is a pretty simple concept. Supermarket coupons. Now, this is not a Doritos class. So let's take a look, guys. Okay. Let's say IBM was trading at $141.75 a share. Okay. Now, the reason I'm going to use 100 shares, while there are only two options, calls and puts, options are traded in contracts. And each contract gives you the right or the obligation to buy or sell 100 shares. Okay? So if I bought one call option, I have the right to buy 100 shares of a stock at a certain price, no matter how high it goes. If I bought one put option, I have the right to sell 100 shares of a stock at a higher price, no matter how low it goes. Now, obviously, you can buy stock in less than 100 share increments, but for our purposes today, I'm going to compare the buying of 100 shares of stock with the buying of one call option. Because another benefit to options, first of all, now that we've taken the concept and oversimplified it, you're going to see a lot of benefits to trading options. Okay, now, if IBM was trading at $141.75 a share, okay, now, what if I thought IBM was going to go higher? What if the stock was at a demand zone or a support area or whatever? For whatever reason, you believed IBM was going up. Jim Cramer threw a chair at the screen and went booyah. You had visions in your sleep one night. Okay, someone who works in the company gave you some inside information. Whatever. You had reason to think IBM stock was going to go up from 141.75. Just like Mary had reason to think the Doritos were going to go higher, and she paid $3 for the 99-cent coupon. Okay. What if I bought a 135 call option expiring in June? Now, what is a 135 call option? Well, as I mentioned, call options give you the right to buy a stock at a certain price, no matter how high it goes. So if I'm buying a call option at the 135 strike price, what I'm buying is a coupon giving me the right to buy IBM at $135 a share, no matter how high priced the stock goes. Make sense? Okay. Now, when the Doritos were $3.99 and the coupon was 99 cents, you all knew, Lee certainly knew, the intrinsic value of the Doritos coupon was $3. Well, if I have the right to buy IBM at $135 a share and IBM is trading at $141.75 a share, what is the intrinsic value of this call option? $6.75. Why $6.75? Because if I paid $6.75 a share in order to only buy IBM for $135, I would get IBM at the current price of $141.75. Just like Mary paid $3 to buy the Doritos at 99 cents, she got the Doritos for $3.99. That's it. And just like the Doritos coupon expires Friday night at 11 o'clock, this option expires on June 17th at 4 o'clock. Why 4 o'clock Eastern time? Because that is when the stock market closes. That is the expiration day of the option. It's usually a Friday, though not always, depending on the asset, but it's usually a Friday. And it expires or it closes when the market closes, just like when the supermarket closes at 11 o'clock, the stock market closes at 4 o'clock. So this option expires in 21 days. If today is Friday, then you have the right to buy the Doritos until tonight at 11 o'clock. If you had this call option, you have the right to buy IBM stock at 135 a share for the next 21 days whenever the market's open. That's it. Make sense? Okay, now, remember, I'm comparing a call option to 100 shares of stock. Now, if you were going to buy 100 shares of IBM at $141.75 a share, that would cost you $14,175. Okay, now that's a lot or a little depending on the size of your account. That's none of my business. But it would cost you $14,175 to buy 100 shares of IBM stock. Now, just like that Doritos coupon we sold for $1 or $2, this 135 call option is going to cost you $8.45 to buy it. Lee paid $1 for the 99-cent coupon. Shar paid $2 for the 99-cent coupon. You are going to have to pay $8.45 for the 135 coupon. Okay? Now, because options are sold in contracts and each contract gives you the right to buy 100 shares, if the option premium is $8.45, it would cost you $845 to buy the coupon. Now, if you bought 100 shares of IBM for $14,175, what's the most you could lose on that trade? $14,175. I know IBM is probably not going to zero, but you are spending and risking $14,175. If you bought a call option for $845, what's the most you could lose? $845. So here's another benefit to options. Some of you may not be able to afford to trade shares of IBM because you don't have the money, but because options are derivatives of a stock. There are many scenarios where you can afford to buy the coupons without ever having to afford to be able to buy the stock. Okay? Now, that option will cost you about $845. Options are a leveraged asset, just like futures, just like Forex. Okay, now, this option premiums consist of two things. The intrinsic value, which we know it has to have. Well, wait a second. If this option is only worth intrinsically $6.75, why are we paying $8.45 for it? Because why are we paying an extra $1.70? Because we are paying for time. See, you don't pay for time when you buy the supermarket coupon, okay? But we are going to pay for 21 days. Options have time value beyond the intrinsic value. Options are the only asset class where when you buy an option, you're buying time, and when you sell an option, you're selling time. Options are the only asset class where you're going to buy or sell the option for more than it's intrinsically worth. If IBM stock's at $141.75, you're only going to pay $141.75. You can't sell it for $145 if it's trading at $141. You can't buy it at $137 if it's trading at $141. But option premiums have time value. Okay, now this is only one expiration date. There are many, many expiration dates, and you'll have to learn which one to choose. So I'm just doing this for today's purposes for this example. So I just want to be clear. The option premium, the coupon, consists of intrinsic value and time value. $8.45, $845. Now, let's talk a little risk management, shall we? Again, whether you think $14,000 is expensive, would you put 100% of your account in one trade? Would you put even 50% of your account in one trade? I certainly hope not. Well, I follow, for me, and at Pinnacle, we teach risk management. Personally, I use what I call the 10% rule. I would not put more than 10% of my account at risk in a single trade. That doesn't mean I'm prepared to lose the whole 10%. Okay? But I'm not going to, I don't want one trade to take me out. If you put 50, 60, 70% of your account in a sure thing in one trade and it blows up against you, one trade could blow up your account. But if you put no more than, for my purposes, 10%, now you could use 5%, 12%, that number will be up to you. But it's appropriate risk management. But that means if you're going to buy 100 shares of IBM for $14,000, you need a $141,000 account. Again, that's way beyond the trading account size that most people have. However, if you're going to buy a coupon, if you're going to buy an IBM call option for only $845, you could do that trade in an account that has less than 10 grand in it, less than $9,000. Wow. Guys, look at this. First of all, you may not be able to afford, if you have a $10,000 account, you couldn't forget 140. If you had a $10,000 account, even if you wanted to put 100% of your account in one trade, you couldn't buy 100 shares of IBM. But if you had a $10,000 account, you could buy a coupon, you could buy one call option for less than 10% of your account in a $10,000, even a $9,000 account. And what you bought, just like the Doritos coupon, you had the right but not the obligation to buy Doritos for 99 cents a bag. You're buying the right to buy IBM for $135 a share, no matter how high the stock goes. Now, obviously, the stock could go down. There are no guarantees. But guys, if you spent $14,000 for IBM stock and you even had a 10% stop loss, think about it. You had a $141,000 account. You put $14,000 in one trade. You put a 10% stop loss on the trade. You lost $1,400. You're thinking, all right, that's pretty good. I only lost $1,400 in a $140,000 account. Well, remember I talked about it in the beginning. Most people think options are risky because a lot of options expire worthless. And most people think if you buy something and it expires worthless, that's a bad thing. Well, it's not a good thing, but guys, we pay our bills with real dollars, not with percentages. Even if I lost 100% of the call option, I still lost less than 10% of the stock. I'd rather lose 100% of $845 than 10% of $14,000. So options allow you to potentially profit on the movement of stocks you can't even afford to buy, with less risk and greater profit potential and greater rates of return if you're right. So let's take a look. Let's compare the coupon to the Doritos. Let's compare the stock to the call option. Now remember, this is a bullish trade. You're buying stock, you're expecting the stock to go up. You're buying a call option, giving you the right to buy a stock at a certain price. You're expecting the stock to go up. So again, whether you're using support lines, demand zones, Fibonacci's, I don't care, lagging indicators, whatever rationale you're using to think the stock's going to go up, let's do a comparison. So let's say IBM was at 142 a share. I just rounded the 141.75 to 142. IBM's trading at $142 a share. And you think that's a demand zone. And you think the stock is going up. And let's say your profit target, your resistance area, your supply area is 170. Okay. You bought IBM stock at 142, the stock went to 170. Woohoo! No guarantee it's going to get there, but if you're right, if it gets there, you just made a profit of $28 a share. Okay. Anybody have a problem with that trade, making 28 bucks a share? If you have a problem with that, we have support groups for you. Okay. Now, you just made a profit of $28 a share, which is a 20% rate of return on the stock price that you paid. Okay. Now, because options are sold in contracts again, and each contract gives you the right to buy 100 shares. If you bought 100 shares of IBM at $142 a share, you made $28 a share profit times 100 shares. You made a $2,800 a share and made $2,800 of profit, which is a beautiful thing, a 20% rate of return on your $14,000 investment. But remember, in order to even do that, following conservative money management rules, you needed a $142,000 account. Okay. Most people won't take that trade because they can't afford to take that trade. Well, remember, Lee, Shar, Mary, myself, nobody had to buy a Dorito. When you trade options, you not only don't have to buy Doritos, you don't have to buy stock. So watch. Let's look at the coupon or the call option. So when the stock is at 142, we're not going to buy the stock because we're trading options now. Now, again, one more time. As an options trader, you never, ever have to buy stock. You can just trade options. If any of you trade futures contracts, you're trading oil futures, gold futures, soybean futures, you never have to buy the gold, the oil, or the soybeans. You're just trading futures contracts. So if we're going to buy, when the stock is at 142, we're going to buy a coupon giving us the right to buy the stock at 135. And we already said our profit target, our opposing zone, is at 170. Okay. Well, guys, just like if you bought a stock at 142 and the stock went to 170, you subtracted the cost from what it's worth and you got your profit. Well, how do you profit with options? Well, if we have the right to buy IBM at 135, the stock's at 170, what does the intrinsic value of this coupon now have to be? $35. If we paid $35 for the right to buy IBM at 135, we're going to get the stock at the now current price of 170. Well, $35 is what the option has to be worth intrinsically at expiration. What's our profit? Subtract the $8.45. We now made a profit of $26.65, which is a 315% rate of return. Let that sink in for a second. We made a $28 profit on the stock, which was great. $2,800, 20% rate of return. On the same movement of the underlying stock, we made $2,665, but got a 315% rate of return for only an $845 risk of an $8,400 account. Now, I know what some of you are thinking. The stock buyer actually made more money. Yes, he did. Made an extra $135. But he had to invest $13,500 more in a $140,000 account. And by the way, do you know how you get to grow smaller accounts faster? You get better rates of return. Now, I said this a few minutes ago. Obviously, this is assuming the stock gets to 170. Okay? Obviously, Lee, we knew it was even if we did. Okay, we don't know the stock is going to make the opposing zone. When the stock's at 142, there's no guarantee the stock's going up at all, let alone getting to 170. Okay, so even just on the entry to the trade, you risked less because you only spent $845. Okay, so boom, less risk and virtually the same reward. And I don't think there are too many of you that would be crying and moaning on $135 less profit, given the rate of return and the size of the account you needed to make it. And guys, how intimidating are options now, Lee? Now, what's intimidating is supply and demand, getting the direction right. Why do you think IBM's going up? Well, that's a whole other conversation. We're not going to get into that today. Today, I'm just introducing you to coupons and introducing you to options. Why you think the stock may go up, that's supply and demand. That's where are the institutional orders? What makes the price of an asset move? That's what that's really what we do at Pinnacle. We help you hone your skills to be able to time the market, okay? But there's no guarantee any trade you get in that the asset's going to do what you thought. Any bullish trade, the stock can go down. Any bearish trade, the stock can go up. That's okay. I mean, that's life. If there were guaranteed profitable trades, I not only wouldn't be here talking to you, we'd all be billionaires. Okay. And that's obviously not the case. So, how cool are these coupons? How simple as a concept are options? Now, obviously, I way oversimplified it today. I just gave you one expiration date, June, and one strike price. When you pull up an option chain, there might be 25 expiration dates to choose from. And each expiration date might have 20 or 30 or 40 different strike prices, different coupon prices to choose from. You have to learn which expiration date to choose, which strike price to choose, and okay. But before you learn about all that, you have to understand a very simple concept. Now, another benefit to options. Who knows what the FANG stocks are? Many of you have heard of these. Facebook, Apple, Amazon, Netflix, Google, Microsoft, Tesla. There's a lot of stocks there that people look at, but the FANG stocks for the last 5, 6, 7 years, okay? How many of you wishes you owned these stocks and profited off their meteoric rise the last few years? Probably most of you. Who doesn't wish they didn't buy Amazon 10 years ago, 5 years ago, or Netflix or Google or Apple or Facebook, okay. The FANG stocks are prohibitively expensive, okay? And that's even right now. Okay, look at this. As of this morning, Apple was at 148, Facebook 192, Netflix 191, Google 2200, Amazon 2200. By the way, 6 weeks ago, 3 months ago, Amazon was at 3200 a share. Even with the stock, every one of these stocks is down year to date, even after this week. And yet, look at the price of these stocks. Oh my God. Okay. 100 shares of Google. You want to buy 100 shares of IBM for $14,000? 100 shares of Google, $250,000. Even 100 shares of Facebook is almost $20,000. Okay. Wow. Okay. I mean, these are the stock. I mean, yeah, you could all afford to buy shares of Ford for $12 or some of the, but really, these are the stocks that are driving the market. Well, guys, remember, you didn't have to buy IBM for 14,000, and you don't have to buy these stocks for that amount of money. Now, just to be fair, Google and Amazon are not going to have cheap options because they're not cheap stocks. But for those of you, you can still trade options on these stocks for a fraction of what it would cost you to buy the stocks. And then finally, here's why I think options are not just the greatest asset ever invented, but why they're the easiest to trade. What if you could profit off of those FANG stocks or any stock for a fraction of what it would cost to own the stocks? That's the IBM example I just gave you in the coupon example. What if you could profit off the FANG stocks without ever having to own the shares? Unless you want to. Most of us can't afford to want to. What if you could profit off of those stocks for less than $5 or $10 a share of risk, even if the stock went to zero? Do you know there are option strategies, what's called spread trading, okay? Where let's say you did a spread trade on Amazon, a $2,300 a share stock. I could enter a bullish spread trade on Amazon, a $2,300 a share stock. Amazon could go to zero, maybe risk $5 or $10 a share, even if the stock dropped $2,300 a share. What if you could profit on a stock's move, even if wrong on the direction the stock moved in? There are option strategies. Remember I showed you that option premiums have time value? You're paying for time. Well, guess what, guys? Here's the one guarantee in life. I can't guarantee whether a stock's going to go up or down. I have no idea. Even if I think I'm right, I have no idea. But you know what I can guarantee? Time. Time will move forward. That IBM option that I gave, that example, expires June 17th. I have no idea where IBM stock is going to be on June 17th. But you know what I can guarantee you? June 17th is going to be here. June 17th is going to get here. And frankly, if June 17th doesn't get here, we have bigger problems than our than our IBM call option. But when you remember, I said when you trade options, you're buying and selling time instead of just the intrinsic value of an underlying asset. So what if you could profit on a stock's move, even if you were wrong on the direction the stock's moved in? Now, Lee mentioned that he has some experience with stock. Lee, what if you could get paid to buy the stocks you want to buy at the price you want to buy them? Or get paid to sell your stock at the price you want to sell it? Now, I don't mean, Lee, if a stock is trading at 80 and you want to buy it at 75, you place an order, and if the stock drops to 75, you buy it at 75. Then you're still just buying the stock at the current price. But what if you could get paid money to buy the stock you want to buy for $75 a share, and then get paid to sell your stock? There are option strategies that allow you to do that. And finally, and this may be a good time to talk about this, given that the markets are down 10 to 20% year to date. How many of you have car insurance, life insurance, homeowners insurance, health insurance? Who's got stock insurance? Who's got IRA, 401k insurance? Probably nobody. Guess what? There are option strategies that, for all intents and purposes, will act as an insurance policy against loss. Now remember, just because you have an insurance policy doesn't mean you won't take the loss. You have car insurance doesn't mean you're not going to have an accident. You have home insurance doesn't mean your house ain't going to burn down. If the market's going to tank and you're sitting in mutual funds in an IRA or a 401k, you're going to lose the value of those assets. But there is an option strategy that, as I said, for all intents and purposes, will act as an insurance policy to make you whole financially if done properly. So guys, those are some of the benefits of options. Think of them as coupons. Think of buying rights and selling obligations. Given the prices of many stocks that you might want to trade and you can't afford to, learn how to trade them using leveraged assets. And then for all of these reasons, learn how to trade stocks that trade for thousands of dollars for $5 or $10 a share of maximum risk if you're wrong. And for those of you that still trade stocks, learn how to get paid to buy the stocks you want to buy, where you want to buy them, and then get paid to sell your stocks where you want to sell them. Wow. Okay? And insuring your stocks, if the value of your stocks or your 401k. All right. They're coupons, boys and girls. That's it. They're coupons. So that's it for today.